Welcome to Then and Now, a podcast by the UCLA Luskin Center for History and Policy. We study change in order to make change, linking knowledge of the past to the quest for a better future. Every other week, we examine the most pressing issues of the day through a historical lens, helping us understand what happened then and what that means for us now.
Welcome to Then and Now, the podcast of the UCLA Luskin Center for History and Policy. I'm Shubhanga Pandey, hosting today's episode, and today we'll be talking about sovereign debt crisis impacting countries around the globe and the role of multilateral financial institutions in managing the international economy. In the decades since the global financial crisis of the 2007-8, a number of countries have faced and succumbed to sovereign debt crises and declared bankruptcy. After Greece, Ecuador, Venezuela, Argentina, Zambia, and Lebanon, Sri Lanka has most recently joined the ranks of countries wrecked by economic downturn. In this context, what role have institutions that were formed to manage the global economy played in the past and in the contemporary times? As organizations like International Monetary Fund and the World Bank come under growing scrutiny and critique, do we see them helping or hurting the economic prospects of the global south? These are the questions we plan to discuss with our two guests, Dr. Ahilan Kadirgamar and Professor Jami Martin. Joining us from Jaffna in northern Sri Lanka, we have Ahilan, who is a political economist and a senior lecturer at University of Jaffna. He has written extensively on Sri Lanka's economic history, its neoliberal experiences, and the recent debt crisis faced by the country. From Cambridge, Massachusetts, we are joined by Jami, who is an assistant professor of history and social studies at Harvard University. He is also the author of a recently published book, The Meddlers, which traces the origins of global economic governance and the political conflicts it has generated. Welcome to you both to the podcast.
Great to be here.
Thank you for having us.
Perhaps we can start with you, Jami. Now, a recent book, The Meddlers, Sovereignty, Empire, and the Birth of Global Economic Governance, proposes an alternative history of international financial institutions like the IMF and the World Bank. So, at the outset, could you briefly introduce these institutions to our listeners, why they were formed, what they do, and also tell us how the origin story you offer differs from the well-known narratives about these institutions?
Yeah, so there's long been a general assumption that what we know of as global economic governance today first emerged at the Bretton Woods Conference of 1944, when representatives of over 40 countries met in New Hampshire just after the Allied invasion of Europe had begun during the Second World War. Their aim was to recreate a world economy that had been thrown into chaos by the Depression and the war, and to create two new powerful international institutions, the IMF, the International Monetary Fund, and the World Bank, which of course still exist today. Now, the purpose of the IMF when it was created was essentially to help member states to weather short-term financial instability and balance of payment problems, while the World Bank was designed to provide long-term development and reconstruction loans. Now, the Bretton Woods system itself lasted for, give or take, 3 decades until the early 1970s, when in the face of a period of global economic turmoil, the United States removes the US dollar's peg to gold and kind of thereby brought the Bretton Woods system formally to an end. But these two institutions didn't go away, right? They actually become more powerful as they search for new missions in the wake of the end of the Bretton Woods systems, undergirded by rising neoliberal policy shifts and then harnessed for US foreign policy aims at the end of the Cold War. So in the 1980s, the Bretton Woods institutions come to play a major role in responding to sovereign debt crises globally, when a series of states, first in Latin America and then elsewhere, begin to default on their huge foreign loans, leading to years of instability and anemic economic growth. So the IMF particularly becomes infamous during this period of time as a kind of painful disciplinarian, right? Kind of demanding states in search of its assistance that they kind of commit to domestic neoliberal policy reforms and austerity as this institution moves away from the supposedly kind of Keynesian ideals that it was founded with in the 1940s. So this is the kind of the basic shape of this narrative, right? These institutions emerge in order to do something brand new at the end of the Second World War, and they're born with this kind of rough Keynesian New Deal consensus, and that only later in the 20th century do they kind of drop their commitment to these ideals as they're harnessed for this kind of neoliberal globalizing revolution, kind of particularly at the behest of the US government. And there's obviously some truth to this narrative. It's certainly true that Bretton Woods was an enormously significant event in the history of the world economy and in global politics, and that the end of the Bretton Woods system did bring real changes to the world economy and to these institutions. But Bretton Woods wasn't the first time, in fact, that states and private actors and empires had attempted to kind of superintend the global capitalist system with international institutions and with these kind of new public-private ways of projecting financial power. In fact, the origins of global economic governance really can be dated to an earlier period. Really, this process begins to develop during the First World War, and as a result of the particular ways that the war transformed the relationship of empires and the globalized world economy that had emerged before the war. So one way of kind of thinking of the significance of retelling this history, I think, is to try to move us away from narratives that kind of nostalgically render the mid-20th century as a moment in which, you know, kind of New Deal inflected liberal internationalism really stabilized the global economy in ways that, you know, kind of brought global public goods for all under this period of benign US hegemony or something like that. In fact, we should see the IMF and the kind of the emergence of the kinds of powers that it would wield in the later 20th century is tied to a much longer and deeper history of, you know, changing ways in which financial institutions and powerful states have cooperated to project power. A story that really begins in the 19th century and that, you know, continues to develop throughout the 20th up until the present day.
Thank you. Now, Ahilan, Sri Lanka has been an important trading hub in the Indian Ocean and, of course, has been closely connected with the global economy. But it's also had an interesting relationship with the IMF and the World Bank since its independence in 1948. Can you give us a brief account of that relationship and tell us what role that has played in Sri Lanka's post-colonial economic history?
Sri Lanka gained independence in 1948, and the British, who had ruled Sri Lanka for the previous century and a half, had a strong hold on Sri Lanka. But when it gained independence, our finance minister at that time, J.R. Jayawardena, decided to go to Washington for support rather than London. And in fact, we had to form our own central bank. And our first central bank governor was actually an American, John Exter. Not only did support for the central bank come from Washington, the World Bank arrived on a big mission in 1951. And over the next 2 years, they drafted a major report called The Economic Development of Ceylon, running into 800 pages. But they wanted Sri Lanka to continue as a dependent economy, focusing on agricultural production, particularly the cash crops, tea, rubber, and coconut. And that trajectory, along with recommendations from the World Bank that Sri Lanka should cut its subsidies to its population and bring about some amount of fiscal consolidation. So this was back in 1953. And those austerity measures actually led to the emergence of a different kind of regime in 1956, which went more towards the Soviet Union and non-alignment. The import substitution regime that was there in Sri Lanka from 1956 to 1965 took a turn again back to the more colonial right-wing party that had gained independence, the United National Party, in 1965. And that is when, again, further support came from Washington, this time from the IMF. So our first IMF agreement, a standby arrangement, came in 1965, and almost every year after that, we went into an IMF agreement until again there was a change towards a left-leaning united front government in 1970. So Sri Lanka's relationship with the World Bank, with the IMF, the amount of capital that came into Sri Lanka, and its level of openness in those first 2.5 decades after independence depended on whether Sri Lanka was more aligned towards the socialist bloc and non-alignment, or towards the West and the United States in particular. With the long crisis in the 1970s, the OPEC oil shock, and so on, Sri Lanka also went through an economic crisis. And again, the party of J.R. Jayawardena, who was finance minister back in 1949, he came now as prime minister, and he took Sri Lanka much more closer to the United States. Sri Lanka went through 2 significant IMF agreements in the late 1970s, what we would call structural adjustment, and started to follow neoliberal policies, what here we call open economy reforms. This trajectory towards free market policies continued, and over the last 5.5 decades, Sri Lanka went through 16 IMF agreements. And last month, Sri Lanka signed its 17th IMF agreement, as the country has been in a deep crisis over the last year, and for the first time in its history, having defaulted on its debt. So Sri Lanka's economic history is very much tied to the external world and to the larger powers, a shift from the British Empire towards US hegemony, and in that process also led by the policies pushed by the World Bank and IMF.
Thank you, Ahilan. Now, Jami, IMF, one of IMF's chief responsibilities and roles has been in kind of responding to these defaults by nation states. So, how has the IMF responded to sovereign debt crisis over the past few decades? And from the perspective of the countries that underwent such crises and were seeking their support, how did these IMF programs impact their ability to pursue independent economic policies? What one might consider their ability to exercise economic sovereignty.
So the IMF really steps into a central role of dealing with sovereign debt issues after the end of the Bretton Woods system of fixed but adjustable exchange rates in the 1970s, when, as I mentioned, the institution kind of had lost its original mandate and was looking for a new mission. So particularly after the period of sharply rising interest rates in the United States, the so-called Fokker shock of the late 1970s and early 1980s, is followed in short order by a period of extreme debt distress globally. This is the moment in which the IMF really kind of steps into this new role of really kind of attempting to deal with issues of financial instability globally in new ways. The IMF then again expands its powers during the period of time in which the Soviet Union is falling apart, kind of overseeing the transition of many formerly Soviet republics to capitalism, and then again during the so-called Asian financial crisis of the late 1990s. Now, the late 1990s crisis was not really a crisis of sovereign debt. In fact, it was much more a crisis of private debt, but nonetheless was a huge global financial crisis, and one that the IMF immediately treated as though it were a crisis of public finances, demanding states like South Korea, Thailand, and Indonesia all slash public spending and raise interest rates, even though none of these states had been running up huge deficits or seen much inflation in their economies. So really, in this late 1990s context, you see the IMF's already kind of worsening reputation fall even further, as it's seen as prescribing this kind of one-size-fits-all policies for its very different member states, as this kind of stern disciplinarian demanding far-reaching austerity and unpopular liberalizing reforms. And really, IMF conditionality at this moment becomes synonymous with the Washington Consensus and this kind of muscular post-Cold War U.S. Economic diplomacy. But the idea that the IMF was doing something brand new at this moment, at the kind of the height of the neoliberal era, I think misremembers that even since its beginning, the IMF has always attached conditions to its loans, at least to some of its member states, and that there was nothing new at this moment about international financial institutions demanding that the recipients of their loans really commit to these far-reaching domestic schemes of austerity and painful domestic reforms. As Ahilan has just mentioned, right, Sri Lanka was already being advised to do this in the early 1950s by the World Bank. So this kind of austerity-linked assistance has very deep origins, actually origins into the 19th century. And this style of kind of conditional financial assistance was further developed during the interwar period and then readopted by the IMF after the end of the Second World War. So this really isn't a new problem just of the late 20th century. This is a very kind of old political issue. It's an old style of bankers' diplomacy, and one that is almost always very, very unpopular and very differentially deployed on the global stage. So most recently, you have seen something of a broad global backlash to the IMF, certainly since the late 1990s crisis. So the institution has never been put out of a job, right? It kind of comes back, let's say, during the Eurozone crisis. And today it's making a record number of bailout loans and kind of centrally involved with many countries that are experiencing extreme debt distress at this moment. Obviously, Sri Lanka, but also Pakistan, Ghana, now recently Ukraine as well, and a large number of other states. So it's a kind of a quieter, softer institution, perhaps in some ways, but one that still essentially operates in ways that it always has, demanding fiscal consolidation in exchange for financial assistance.
Thank you, Jamie, for painting that really interesting historical picture. Now, bringing us to more recent times, Ahilan, Sri Lanka's debt crisis and eventual bankruptcy, made much news over the past year. And so last month, the IMF approved a $3 billion loan to support economic recovery and what's being called reforms in the economy. Can you give us a summary of what led to that debt crisis in the first place, what some of its major fallouts were, and what this new IMF loan might mean for the country?
Sri Lanka was the first country in South Asia to liberalize its economy with the IMF World Bank Structural Adjustment Program back in the late 1970s. And since then, we've been following free market policies. We've had periodic balance of payments problems with periodic IMF agreements. But because there was a civil war in Sri Lanka since 1983, these neoliberal policies were not moved as speedily as the government or the IMF would have wanted, because the urgency of fighting the civil war kept the government from accelerating liberalization. But it is with the end of the war in 2009, which also coincided with the global financial crisis of 2008, that Sri Lanka, just 3 months after the end of the war in July 2009, went into its 15th IMF agreement. And that gave the green light for Sri Lanka to borrow extensively, including from the international capital markets. Sri Lanka floated its first international sovereign bond in 2007. But after 2009, it started floating billions of dollars in sovereign bonds, and the debt started to increase. So while liberalization of trade and financialization had been there the previous 3 decades, it accelerated after the war in what I call a second wave of neoliberalism in Sri Lanka. Now, that initially showed high growth. Sri Lanka was congratulated by the various donors because we were showing 8% growth per annum in 2010, 11, and 12. But that bubble-like growth with financialized investment in infrastructure and urbanization petered out, and then we got into trouble. Again, in 2016, we went into our 16th IMF agreement. In June 2016, we went into an extended fund facility for 1.5 billion US dollars. But that gave us the green light the next month itself to go and float 1.5 billion US dollars in ISBs. And between 2016 and 2019, we floated close to 12 billion US dollars in international sovereign bonds, which in many ways led to an unsustainable debt stock. Of course, the COVID crisis and then the war in Ukraine pushed us over the cliff, so to speak. But our debt was already unsustainable. And there is this question, so what was the IMF's debt sustainability analysis like all these years? Why couldn't they see that this sort of openness of the economy was going to bankrupt us? And that is what happened a year ago in April 2022, when Sri Lanka said that it cannot repay its external debt. And this is the first time in our history, in our post-colonial history, that we defaulted on our debt. And over the last year, we've been trying to get an IMF agreement and implementing all the recommendations of the IMF, the austerity measures, market pricing energy, which means the price of fuel has tripled, electricity costs have tripled, and we devalued our rupee, so all imported goods, including essential foods, have the prices have doubled, and food inflation going up to 90%. So it's been a very deep crisis, and it took almost a whole year for the IMF to, for its executive board to approve an extended fund facility, and also now the IMF is the arbiter for debt restructuring with a whole range of creditors. There is the bilateral donors, the largest one being China, then Japan and India. There are the multilateral donors, though multilateral donors, including the World Bank and the ADB, say that their debt cannot be restructured, that they are an exception, which is also questionable. And more importantly, 53% of our debt is commercial borrowing, and a lot of them are bondholders. And whether this process of debt restructuring would go smoothly, only time can tell. But what we know is that Sri Lanka is now caught in a long crisis, despite having reached an IMF agreement, and what looks ahead is more austerity, even as we struggle to get through debt restructuring agreements from these various creditors.
Thank you, Ahilan, for that. So, in light of these critical observations, that we've made about the IMF and the World Bank and their programs, Jami, I want to ask, what it might take to construct a more equitable system of international finance, and might alternative actors and institutions, and here I'm thinking of economic powers like China, or organizations like the New Development Bank, led by emerging economies like Brazil, Russia, India, China, South Africa. I mean, do you think these institutions might play some role in kind of creating a more progressive financial arrangement?
So I do think that there is real energy for reform, at least among some constituencies at the moment, in thinking about creating more sustainable, just, and representative institutions of global economic governance for the 21st century. And really, I think this is in part because of this confluence of factors that many states are now facing, which, as Ahilan just described, led to Sri Lanka's default last year, right? There's kind of swiftly rising debt loads since the global financial crisis, the war in Ukraine, and the global cost of living crises produced by the shocks that delivered to the world economy, the pandemic, and now rising interest rates, not to mention the climate crisis. I mean, really forcing states that already had unsustainable debt loads over the cliff, right? And it just seems harder and harder that the idea that what you would demand of these states is the same old recipes for austerity, right? Even though that this does tend to be what the IMF demands in most conditions, right? How can you propose austerity, for example, in the face of the obvious need for investments in climate resiliency and green transformations, for example? So what are some of these demands for reforms? I mean, one thing that does seem apparent is that international financial institutions do perform a useful function in the world economy, right? I mean, they provide the closest thing that approximates some kind of global financial safety net. But the resources at the disposal of these institutions are clearly not commensurate with the scale of challenges faced globally. So one kind of common demand is for actually the resources to be augmented by member states to contribute more, particularly obviously the wealthiest member states, but also that these resources be made available to member states that need them with fewer strings attached, right? That you don't demand this kind of painful conditionalities as the price of seeking out emergency loans or seeking out concessional loans for the sake of investing in green transition. So one tool that is quite popular among groups calling for reform are the so-called special drawing rights, right? These kind of ways in which liquidity can be made available to states without the same kind of conditionalities. Of course, the issue is that special drawing rights, when they're issued, go to all member states of the IMF. They go to states that need them and states that don't. So part of the mobilization right now around SDRs is essentially looking for better ways of recycling them, getting them from states that don't need them to states that do. But essentially here, the idea is that the IMF does have this tool at its disposal for making liquidity available, without the same kinds of policy strings attached. There's still the kind of age-old problem of how to make these institutions more representative, how to reform quotas so that you get a much more kind of equitable share of power within these institutions. This is obviously a kind of reform that the U.S. government has traditionally opposed, obviously because of the veto power that it wields in the IMF. Perhaps understandably, right? The U.S. government doesn't want to countenance any reforms that would force it to give up this power of veto. One area where I do think there is a kind of renewed energy, even within the IMF, is for addressing issues related to climate. But again, there is this kind of tension, right, where obviously states that are facing climate crises, the kind of last thing that they need is austerity, right? I mean, they need fiscal space, they need policy space to invest in the infrastructure and the resiliency that they need, right? So there is, for example, the Bridgetown Initiative, which is proposed by the Prime Minister of Barbados, Mia Mottley, really calling for a kind of fundamental rethinking of international financial institutions and the way in which they make financing available for states facing, the kind of front line of the climate crisis, right? To kind of come up with ways of mobilizing and channeling resources into greater climate resilience and kind of infrastructural adaptations to deal with climate problems. And then, of course, as you mentioned, right, there are this kind of growing number of alternative institutions like the New Development Bank, as you mentioned, and other Chinese-led institutions. I mean, many of these institutions are quite new, and in a certain way, we'll see. We'll see if they are able to develop alternative means of addressing some of these persistent problems, but in new ways. I mean, one of the issues faced by some of these more regionally focused institutions is that they don't have the resources available to them, again, that are commensurate with the scale of the challenges. I think obviously the other issue that many of these institutions face is how to navigate rising great power competition. How can they avoid being caught up in particularly US-Sino kind of competition, and how can they carve out real kind of independent internationalist approaches? But I do think, one of the perhaps, let's say, positive externalities of US-China competition, if we can speak in this way, is that it is, encouraging a look for a search for alternatives, right? And it's providing states with some limited leverage in the world economy at this moment to try to press for some new directions and how these challenges are dealt with.
Ahilan, and this will be the final question of our conversation. Essentially, the same question to you as well. What would a more equitable kind of financial arrangement internationally look like? And particularly from your vantage point in Sri Lanka, what do these new alternatives and let's call them non-West-led financial order? What are its promises and its potential perils?
Yes, I think for most post-colonial states, the question of development was primary, right? After with decolonization, and development financing was critical because we did not have the accumulation necessary for investment for development. But the problem with the international financial architecture, as it has been there since Bretton Woods, is a fundamental question. Like, who was it serving? Was it serving the interests of finance capital in the West, or the development financing needs in the third world? And I think that is a similar question that we are now having to ask with the current wave of debt crisis. What is development financing going to look like over the next many years and decades? Because what we've seen, not only over the last 4 decades of neoliberal financialization, but even since independence, is these repeated financialized crises when we depend on the financial architecture as it's existed. And the question comes up, what kind of new financial architecture might be possible? And development banks are crucial, both, I would say, domestically and internationally. Now, Sri Lanka had 2 development banks that were formed in the 1970s. Both of them, and what we understand, was under pressure from the IMF, turned into commercial banks in the 1990s. So even this idea of development banking on the terms in which developing countries would like to have them has come under attack. So I would put it slightly differently, that it's not just about the existing World Bank and the IMF and the financial architecture. Even the newly emerging ones, even if it's led by China or the BRIC countries, are they really going to work in the interests of smaller developing nations, or is it about pushing surplus capital onto these countries to get the return on it? And of course, then the other issue, what Jami mentioned, is that if it's really going to serve the interests of the developing countries, then there shouldn't be strings attached. The difficult situation now, and the world is in flux, and you might see many changes over the next few years, is that this is not the moment of the 1970s when there was the non-aligned movement, the socialist bloc, which provided some level of cooperation between third world countries and at least some bargaining power that they could go to alternative actors. In 1974, for example, the UNCTAD, and led by actually a Sri Lankan government in Korea, came out with a new international economic order because it was clear to many third world countries that the trajectory in which they were going with declining terms of trade, without the kind of international financial arrangements and development financing, that it was not sustainable. But that proposal, even though it reached the General Assembly, was never implemented because ultimately power decided, the Western powers decided that that's not what they want to do. They want to go further in the direction of liberalization. So I think that's what we are looking at. For countries like Sri Lanka, there is no solution just for Sri Lanka at the moment. We are probably going to muddle through. My fear is that, we'll be knocking on another IMF agreement in a couple of years. And the way that restructuring is going, and the IMF seems much more favorable to the creditors than to Sri Lanka. Even if we did achieve that restructuring, we might be defaulting in a couple of years. And this might be the story of many other countries from the global south, unless there is a new global financial architecture that provides the kind of development financing that could allow countries like Sri Lanka to grow, to meet the infrastructure gaps, but also provide what people need, that is food, to be able to develop their food system and the agriculture system, as well as social protection and social welfare, which is what people fought so hard against colonialism with decolonization. And those questions are now coming back again.
Well, we will conclude our conversation on that cautionary note. And thank you both, Ahilan and Jami, for this rich and informative conversation. Thank you.
Thank you so much.
Thanks, Shubhanga.
Thank you for listening to Then and Now, a podcast by the UCLA Luskin Center for History and Policy. You can learn more about our work or share your thoughts with us at our website, luskincenter.history.ucla.edu. Our show is produced by David Myers and Rosalind Campbell, with original music by Daniel Reichman. Special thanks to the UCLA History Department for its support, and thanks to you for listening.